Let's jump right into it. Today, we're tackling one of the most popular yet somehow wildly misunderstood tools out there, the moving average crossover strategy. It's kind of crazy, right? These things date back to the literal graph paper and ticker tape days, but they are still the absolute backbone of algorithmic and high-frequency trading right now. If you've ever stared at a live chart for Bitcoin or gold and just felt completely overwhelmed by the sheer chaos of those fluctuating candles, trust me, you are absolutely not alone. In this explainer, we're going to use Bitcoin and gold as our main examples to show you exactly how to take all that wild, unpredictable market noise and turn it into clear, objective, rule-based signals. I mean, really, how do you find those clear signals in the middle of all that chaos? That is the million-dollar question. Let's be real, we have all felt the sting of panic buying the absolute peak of a massive green candle purely out of FOMO, only to watch the price instantly reverse and tank. It hurts, but human brains are literally hardwired to fail at trading. We instinctively want to buy when everything looks euphoric and sell when things look terrifying. Without strict mathematical rules, you aren't trading, you're just gambling. And that's exactly what this strategy fixes. It gives you a mathematical line in the sand to help you completely strip the emotion right out of your decision-making. Quick look at our roadmap today. We're covering the power of moving averages, reading those crossover signals, the step-by-step setup, how to filter out the noise, and finally, the most crucial part, risk management and psychology. Let's get to it. Section 1. The power of moving averages. Let's talk about how we actually smooth out that market noise. Okay, the foundation of this whole setup is the simple moving average, or the SMA. Think of it like noise-canceling headphones for your charts. By taking an arithmetic average of closing prices over a specific period, it creates this much slower, smoother line that totally ignores every tiny erratic price tick. Now, you might be wondering why traders are absolutely obsessed with the 50-day and 200-day periods. Well, it's simple. They roughly map out a quarter and a full year of trading days, giving you a phenomenal macro snapshot. Because it's slower to react, the SMA is your best friend for locking onto those massive long-term structural trends that you want to just ride for months at a time. But what if you're trading something highly volatile and you need speed? Enter the exponential moving average, or EMA. This one gives exponentially more weight to recent prices, meaning it hugs the current price action way more tightly. Imagine a sudden massive spike in Bitcoin. The EMA is going to whip upward almost instantly to catch that real-time momentum, while the SMA is still lagging days behind, kind of dragging its feet. For fast, volatile markets, traders love pairing the 9 and 21 EMAs specifically to catch those rapid shifts before the wider market even wakes up to what's happening. Section 2. Reading the crossover signals. This is how we actually spot that momentum shift on the chart. The real magic happens when two of these averages collide. It's the ultimate showdown, the golden cross versus the death cross. A golden cross happens when your fast-moving average, like the 50-day, crosses above the slow one, like the 200-day. This is a massive, visually obvious signal of long-term bullish momentum. Just think back to late 2023. Bitcoin painted this beautiful golden cross that perfectly signaled its aggressive bull run to new all-time highs. Now, on the flip side, the death cross is when the fast MA drops below the slow MA. Total bearish momentum. If you look at the start of the brutal 2022 crypto winter, a glaring death cross warned everyone way in advance. These signals are incredibly powerful because they show an undeniable shift in the underlying market momentum. I absolutely love this quote from our sources. Crossovers translate price behavior into clear, repeatable signals. It literally hits the nail on the head. You're no longer sitting there guessing if an asset is turning bullish or bearish. You look at the chart, and the lines either crossed or they didn't. It is completely binary. If you ever get that totally paralyzing anxiety before pulling the trigger on a trade, this is your antidote. It kills the emotional guesswork entirely and gives you a completely objective basis for entering and exiting. Section 3, Step-by-Step Strategy Setup. Time to put these rules into actual practice. Let's break down exactly how you execute this yourself. Step 1, just add your two moving averages, one fast, one slow. Step 2, identify the overall trend direction. If the price is generally hanging above the slow average, we're bullish. If it's below, we're bearish. Step 3, be patient and wait for the actual crossover. Now, step 4, listen closely because this is where everybody messes up. Confirm with price action. Do not, I repeat, do not just blindly smash the buy button the absolute millisecond those lines cross. Wait for a structural break. That means waiting for the price to print a clear higher high or waiting for a pullback that actually holds the new moving average's support. Waiting for that confirmation is literally what separates the pros who survive from the amateurs who get chopped to pieces. Now, obviously, the numbers you use depend entirely on what you're trading. For quick momentum in crypto and Forex, the 9 and 21 EMA pair is super popular. If you're swing trading major stocks like Tesla or Apple, the 20 and 50 SMA is kind of the sweet spot. And for those big macro views on gold or the broader indices, the classic 50 and 200 SMA is the undisputed gold standard. But here's the real secret sauce: multiple time frame alignment. A 9 and 21 crossover on a 1-hour chart might look phenomenal for a day trade, but you absolutely have to check the daily chart first to make sure you aren't trading straight into a massive macro headwind. Same exact mechanics, but aligning those timeframes is how you actually win.
Section 4, filtering the market noise. This is where the strategy thrives, and honestly, where it fails. Let's talk reality.
All right, time for a massive reality check on the limitations here. In strong, trending markets, this strategy is incredibly reliable. It traps those clear momentum shifts perfectly. When gold breaks into a massive multi-month uptrend, the crossover acts like a safety harness, keeping you in the trade for max profit. But in sideways markets, it is a total disaster. When the price is just consolidating and chopping horizontally, like gold getting stuck in a boring range for months, the strategy's performance is poor and lagging. You're going to get hit with constant false signals. In the trading world, we call this getting whipsawed. You buy the cross at the top of the range, the market instantly reverses, and you sell the cross at the absolute bottom. It will literally bleed your account dry.
And look, this happens because moving averages, by their very nature, lag behind the actual price. It's just math. By the time that crossover actually prints on your screen, the big move has technically already started. You aren't catching the absolute bottom, and you aren't selling the exact top. That's exactly why relying on them blindly is super dangerous. You absolutely need confirmation tools. For instance, if you get a bullish crossover, but your RSI is already screaming at 85 or 90 and looks completely overbought, that is your definitive cue to sit out. Jumping in then is just begging for a pullback.
Section 5, risk management and psychology, protecting your capital, and frankly, protecting your mind.
So how do we protect ourselves when the market inevitably throws out a false signal? First, just avoid choppy, low volatility conditions entirely. If it's chopping sideways, sit on your hands and protect your capital. Second, dial down your position sizing when the market is uncertain. You don't have to go all in every single time. And third, this is totally non-negotiable. Always use a stop loss beyond recent swing levels. Where exactly? Tuck it just below the last major structural low that happened right before the crossover. That way, a totally normal, healthy market retest won't accidentally stop you out. The moving averages might dictate the trend, but your stop loss dictates your absolute survival in this game. There's this great final quote from the sources that sums this all up perfectly. Crossovers help traders stay aligned with market momentum, avoid emotional decisions, and build a disciplined approach. At the end of the day, the biggest psychological win here isn't about perfectly predicting the future. It's about totally removing your emotions from the equation. When you have an ironclad objective system for entries, confirmation, and risk management, the panic selling stops, the FOMO stops. You just simply trust the structure and you trade the system.
Which brings us to a pretty big, provocative question to wrap this explainer up. When you're looking at your own charts, do you rely on moving average crossovers all by themselves? Or are you actively combining them with deep price action analysis? Challenge yourself to think about how you can take these tools and build an objective system that works for you. Just remember, always wait for that confirmation. Thanks for hanging out with me today. I really hope this helps you filter out the noise and find the signal. Keep learning, stay disciplined, and I'll catch you next time.